Hello, everyone, and welcome back to Your Finance TV. It feels like it's been forever since I've sat down with Jay Pelosky for his Friday musings, but you know what? I'm so excited to have him back. I'm so excited to be talking to him. Welcome back to having a chat with me, Jay.
Well, likewise, Scott. I mean, after that, how can I say anything other than I'm super pumped to be chatting with you too? So, yes, happy to be back. 2 weeks of vacation. Know you were on vacation as well, so hopefully it was a good one.
That was a great one. Thanks very much for asking. All right, now let's get into your musings for this week. They're titled Traction. Now, obviously, I've been away, you've been away. Like, have you seen everything that's happening in the markets? Like, maybe you've missed a couple of things. I
Yeah,
doubt it,
no,
though.
I missed a lot. Well, I missed a lot of, I think, nothing, right? If that makes sense, because I was really disciplined about not looking at the computer, not looking at my phone, not looking at TV. So I really disengaged from the markets completely for those 2 weeks. I was out at Fire Island, which is really where the title came from. So Fire Island, for those folks who don't know, is a barrier island off the coast of Long Island here in the state of New York. And in order to get to Fire Island, you need to take a ferry. There are no cars on the island. It's really a different vibe. And that was what I was looking for, to get out of the hustle and bustle of New York, in New York City, where I live and work. And so that's where the title Traction actually comes from, because when you step on the ferry and you pull away from the mainland, it's like vacation has begun, right? And the ability for that feeling to grab hold and to get traction so quickly struck me, because it's been a bunch of years since I've had the pleasure of going and spending some time on Fire Island. And it really hit me, and it stayed with me, throughout these last couple of weeks. And so I did miss some things, right? I guess, because the market, as we know, had a little bit of a pullback, but clearly it was a healthy pullback, right? We went from overbought to oversold very quickly in the space of literally a couple of weeks. You had significant shifts in exposure. The NAAIM exposure levels for IRAs, registered investment advisors, had its biggest 4-week drop since March of 2020, which was when the market digested COVID. So you can imagine the speed of that shift in exposure. And then you had the put call ratio break above 1, which hasn't happened since March of this year. And so you had a very quick adjustment to the market, which we think is healthy. We were expecting a pullback, needed a pullback, and guess what? We got a pullback. And importantly, to the point of traction, it never really got traction to become something more than a healthy pullback, right? So that's good. And it kind of reaffirms the fact that, in our view at least, we continue to have an upward bias towards risk asset prices.
Now, this week we've seen in the markets we had a PCE print. A lot of people still talking about inflation. I'm not hearing as much recession talk anymore. Like, like they're still seeing it from different places here and there, but and your stance has been pretty clear on this, but I'm presuming none of that's changed.
Yeah, no, it's really interesting, right? There are some people still calling for recession, which they should. I don't know. I think they should kind of. I don't know. I won't say anything more. We'll focus on what we're doing. And you're right. Our view has been very solid for over a year. Our middle path, right, which we wrote about the first time last July and August, because that was coming off vacation a year ago. The middle path between high inflation and deep recession. And that's the path that we've been going through, and that's where we're at, right? Inflation has come in. Numbers continue to be very good. The PCE just came out this week, right? Kind of spot on point. The jobs numbers this morning, again, right on point. Average hourly earnings, hours worked, participation ratio went up, which is very good. And the labor market is clearly cooling, but not collapsing. And that fits into the soft landing. In fact, one of the guys I like to pay attention to, Mark Zandi, who's the chief economist at Moody's, called it about as picture perfect a description of a soft landing as we're likely to get. So that's where we've kind of gotten to. And so our focus has been over the last month or two and continues to be shifting away from that inflation, recession, Fed focus, right? We're shifting away from that. That's now going into the rearview mirror. And we're focusing forward on our expectation of a global economic recovery, which is going to be fueled by a manufacturing rebound itself, being fueled by an inventory restocking process, and then the global capex boom that we've been talking about for several years to deal with the 3 Cs of COVID, climate, and conflict. And I would just point out even there that this week, again, we had, as I battled through like the mountain of emails, right? You can imagine 2 weeks of emails, it was just like thousands of them. As I deleted the vast majority of them, I did see that the U.S. Q2 GDP estimate was revised, and it was revised down from something like 2.4 to 2.1. But importantly, the cause of the revision was that inventories were drawn down significantly. Axios, the news service, I think used the term burning through inventories rather than boosting production. So guess what? Once you burn through the inventories, what happens next? You have an inventory restocking. And so that's what we continue to look for. And to throw out a couple of examples of data points supporting that, you had the China PMI with new orders turning up. You had the European manufacturing PMI just came out yesterday, I believe, or in the last couple of days, showing an uptick in manufacturing in Europe, which hasn't happened since January. It was the first manufacturing PMI uptick for Europe literally since January. Still below 50, but moving in the right direction. And here in the U.S., we continue to think that the PMIs for manufacturing are going to break above 50 as we get through the second half of the year. And we look at things like trucking, like transports, like industrials, all of which are breaking out, transports and industrials anyway, breaking out, suggesting that the market is sniffing out this idea that we're going to have a recovering economy and a growing economy rather than a recessionary economy, both for the United States and globally.
Okay. So the other thing that's been happening while we've been sunning ourselves in the nice summer we enjoyed here in the Northeast, there's been plenty more earnings coming out. So I've seen some consumer names that have like sort of disappointed. We've seen some drastic downgrades there, but we're seeing the tech space doing very well. What are you thinking on the earnings front?
Yeah, I mean, it's a good thing that you mentioned that. Thank you, because I did want to do that. Earnings Q2 season is over, right? Better than expected, significantly better than expected. I think the beat percentage was close to 80%, which is above average. So Q2, which is again rearview mirror, better than expected. That's good. But more importantly, I think, is what are analysts doing with forward earnings estimates, right? And there too, estimates are being revised up. And so the 2024 earnings outlook is now something like, the consensus is now something like 247 for the S&P, $247 of earnings versus something in the 220s, low 220s for 2023, which implies earnings growth next year of low double digits, somewhere around 12%. When I did the calculation the other day, roughly 12%. And so that's important, right? Because in 2023, the market's up 15%, the S&P 16%, ACWI globally again, where we've spent a lot of our time and focus since we're global kind of macro shop. ACWI, all country world index is up about 14, 15%, but almost all that's been through multiple expansion, right? Not really earnings growth per se. And so for us to get, and that's typical when you come out of a bear market, the first phase is the expansion of price because the market is sniffing out the earnings that are going to come. And now we need to see those earnings come through to support the S&P and other markets going forward. So key point is not only the backward-looking Q2 better than expected, more importantly, forward estimates continue to be revised up, 12% earnings growth for 2024. That's another reason why we're constructive on risk assets as we move into the second half of the year, now into the fall, and really starting to pay attention to 2024.
Well, mentioning risk assets, another thing sort of happened a little bit while we're away. China, everything seems to be hitting the wall, as so to speak. I actually did see a stat earlier this week that in US investors, the lowest confidence level of China in the longest time. Now, I know you like to be contrarian on these sorts of things, like buck the trend, but what are you thinking on China right now?
Yeah, well, we did add as a quick reminder to reposition ourselves before we went on vacation. We updated our model portfolios, which we have two here at TPW Advisory, one global macro and one thematic, and we update them once a month, and that's coming up. But 3 or 4 weeks ago, when we updated last, we in fact added to China equity, particularly through China Tech and the KWEB ETF, and so we're exposed there. And certainly the last couple of weeks, what's been very clear has been just an absolute deluge of negativity in terms of press. And the best example of that is The Economist, which is famous for its covers, and its covers being contraindicators, right? And so the Economist doubled down on China with back-to-back 2 weeks in a row of negative China covers. And so that's really where the sentiment is. You point out U.S. investors' low confidence. I would point out that foreign selling of Chinese equities is probably going to hit a record in August. I know it was over $11 billion of selling by foreigners, in the last couple of days before the month end. So record selling by foreigners, negative publicity. You can't get more negative. And again, it actually goes back to the traction argument. And one of the things that I really hung in the musings, the traction thesis, is the idea of when will all these drips and drabs of policy easing and support that China has been doing for weeks and weeks, if not months, when do they get traction, right? That is the key question. In our view, having added to China equity a month ago, is that we're getting closer to when that traction should start to grab hold and become visible in the data flow. And I would point out that as we wait for that, I think the negativity is way overstated, just full stop, way overstated. China, which is the second biggest economy in the world, is likely to grow 5% this year, even amidst all this woe and angst about its activity levels, versus, so that's more than double the United States, just flat out growing twice as fast as the US, with a, again, very large economy, second biggest in the world. In addition, I would highlight the fact that, the e-commerce companies, the big China tech companies reported recently, which is why we went into KWEB, and their numbers were fantastic. Alibaba had the best first quarter it's had since it went public 8 years ago. So that's not consistent with a Chinese consumer that's crawled under a rock, which is what you would believe if you believed everything you read about China and consumer. Now, obviously, consumer confidence is low. The property market is weak. That's a main focus for us, and we've talked about it with you before many times. So we're focused on the property market. The government is trying to shore up the property market, just announced over the last day or so a sharp reduction in mortgage interest costs and for first and second time buyers. So a lot is going on. We think the story is not anywhere near as dire as it's being made out to be. That negative sentiment is expressed in valuation. China equity trades at 11 times forward earnings versus 16 or 17 times for the US. So almost a 50% discount. Relative performance versus the US is at a 20-year low. Foreign selling at an all-time record. And yet the company results have been great. The tourist visits to Macau, which is a good indicator of China sentiment because they go to Macau to gamble. Tourist visits are almost back to 2019 levels. Car sales are doing well. And the government continues to drip and drab policy into the economy. We do not expect and have not expected a dramatic, kind of stimulus package, right? One of the things I learned one of the few last times I was in China was that they viewed their big bang policy or fiscal stimulus that came about after the great financial crisis as a policy mistake. And even then, this is several years ago now, it was abundantly clear that they had no appetite to do that again. And I think that's what we're seeing here. I do not expect a huge fiscal stimulus, right? I think we're going to get continued drips and drabs, which should at some point gain traction and give us a sense that the economy is starting to recover. And again, I would point out that the August composite PMI came out this week for China was above 50, right? Signaling expansion. The manufacturing PMI is 49, came in at 49.7, better than consensus, better than the forecast. Granted, below 50, but better than the consensus. New orders above 50 in the latest data point. So, if you have a judicious reading of what's going on in China, I think one can be relatively constructive and think that at 11 times forward earnings, with record foreign selling already in the rearview mirror, the risk reward, looking out 6 and 12 months, is probably pretty good. And so, I just checked KWeb this morning. It's back above its 200-day moving average. We're down less than 2% on the price we paid when we put it into our model. So, for all that negativity to be down 2%, I'm perfectly okay with that. So we continue to be constructive on China.
Okay, so there's a lot to take in and all that sort of side of it, right? And what does it mean for all the asset classes then?
Yeah, no, I mean, granted, we did spend that was a pretty good rundown on China, but I think it's really important. Obviously, big market, big economy. If China was going to really go into the tank, economically speaking, that would be negative for the global economy, right? And that would put our view of a global economic recovery, obviously, at risk. And so we are spending a lot of time on it. And that's our view, is that it is better than what people are making it out to be. And you're absolutely right. In turn, that has big impact on assets. And one of the things that's interesting is that you think about the commodity space as an illustration, right? China is the first or second biggest user of virtually every commodity, whether it's ag, whether it's industrial metals, whether it's energy. They're one of the biggest users. So if the Chinese economy, right, if you just extrapolate, was actually going to implode or was in an implosion, commodity prices would be weak because that demand would not be there. Instead, what do we actually see? Real-time fact, commodities are breaking out, right? CRB is above its 200-day moving average. Oil just went out. WTI went out at a year-to-date high yesterday, at the end of August. XLE is breaking out as we speak, over $90. So clearly, commodities are not imploding. And so the way we're thinking about it is that the markets are forward-looking and smarter than any one individual because it's a collective intelligence. And our view is that stocks are sniffing out that global economic recovery and that earnings recovery we touched on earlier. And stocks are reading, right? ACWI up 15% year to date. Next best are commodities. GSG, which represents the Goldman Sachs Commodity Index, energy heavy, granted, but still a broad commodity index. That's up about 5% year to date. That's the second best performing asset class. It is breaking out. It actually looks like it's starting to break above or break out relative to stocks, which is very interesting because if we have a period where real assets perform, people are very, very underweight commodities. And then third, bonds have been the big underperformer. You just look at the TLT and the long end of the U.S. Treasury curve, been absolutely annihilated this year. And so that to us says that we are, looking for or we're correct in looking for an economic recovery. So as we think about it here, we continue to be constructive on risk. We're overweight equities. We are overweight commodities, both in energy, which we added to a month ago, as well as industrial metals, particularly with an exposure to copper. We continue to be exposed to uranium, which is breaking out on the clean energy side and the climate side. That's a big position for us, URNM, and it looks very, very good. And you're hearing a lot about nuclear power starting to become increasingly important for baseline power, right, to deal with the renewables. Renewables are great, but they fluctuate. You need solid baseline power, and increasingly uranium and nuclear power looks like it's going to be the default there. So our view here, and as we expressed a month or so ago, is we want to be at the periphery of the assets. We want to be in commodities, which are under-owned. We want to be focusing on emerging market equity and debt within the traditional asset classes of stock and bonds. And that was why we added to China. We continue to like local currency emerging market debt. We think the big shift is going to be from a rate tightening cycle, which we think is coming to a close, to a rate cutting cycle, which is being led by the emerging markets, particularly in Latin America. Chile and Brazil are already starting to cut rates. And that is going to be one of the things that supports that global economic recovery that we talked about, as emerging markets start to really cut rates and boost consumption and start the restocking process that we talked about earlier in this episode. So that's kind of the view. We remain positive. We think the global economic recovery is starting to gain traction. We think the policy efforts in China are going to gain traction. And we think that's all constructive for an asset allocation that has a kind of tilt towards risk on, not risk off.
Well, thanks for all that, Jay. It's great to wrap all that up. It's a great rundown over the last few weeks and what we're seeing going ahead. We're going into a wonderful long weekend here. It's the unofficial end of summer and so forth. I know I'm going to be on the golf course. What are your plans? I presume it's got something to do with that shirt you're wearing.
Big Duke, baby. Duke Blue. It's the start of football season. Scott, American football. I know you like Aussie rules and rugby, but American football is kicking off, and the old alma mater, Duke, is kicking off its season on Monday night, national televised game with ESPN at 8 o'clock against number 9 Clemson. And while Clemson is favored, I'm here to say that Duke is going to have the first big upset of the year, upset top 10 ranked Clemson, and the biggest season opening victory that Duke has had in probably decades, if not in modern history. So I'll be in Durham, heading down there this weekend, and we'll be talking about that next weekend when you can congratulate me on my foresight, not only for markets, but also for Duke football.
Well, good luck to Duke. Next week we'll be talking Rugby World Cup because it's France versus New Zealand next Friday.
All right. Well, this is my go round. You can have next week's go round, and we'll just trade back and forth throughout the course of the fall. It's a good time of year. Summer was great. Fall is here. And by the way, fall, September typically means poor seasonality for the S&P. We would buy the dip should it come.
All right. Jay, you have a fantastic weekend. Enjoy the game, and we'll be talking to you next week.
Thanks, Scott. You as well, buddy.
For everyone else out there, good luck investing.